Good afternoon, everyone. Thanks very much for joining me this afternoon for this HMO partner presentation from Sourced. My name's Chris Kirkwood. You might have been expecting Steve and Moss. I think that's who we said was originally going to do this presentation. Steve is our managing director, and he's been held up on site today, looking at a big conversion of a pub into 14 flats. So he's on site at the moment. My name's Chris Kirkwood. I'm the franchise director, and I'll be taking you through this presentation. A little bit more about me later, just to show that I absolutely have the background and the knowledge to take you through this presentation and talk about HMO Partner. First of all, a couple of little bits of housekeeping, as always on Zoom calls. So if you go to your menu, you'll see that you've got a couple of ways to communicate with me through this presentation. You've got a Q&A section, and you've also got a chat section. Now, if you want to ask me a question throughout this presentation, please do so. Please use the Q&A section. That Q&A section allows me to reply to you, and it also allows me to delete your or to sort your question once I've answered it. Where the chat section is a lot more difficult to make sure that I've answered everyone's questions properly. Talking about that chat section, though, you can use either the Q&A section or the chat section right now, just to let me know that you can hear me and that I've flicked all the necessary switches and turned all the necessary knobs just to make sure that you can hear me. So either in the Q&A section or the chat section, if you can let me know. Yeah, great. Thanks very much, guys. Appreciate it. Okay. So without further ado, let's get cracking on this presentation. So first of all, about me, I am the franchise director here at Source. So all of the franchise operation is taken care of by me. We've got a great franchise team, but why am I qualified? I might have the title of franchise director at Source, but why am I qualified to talk about HMOs? Why am I qualified to talk about property investing at all? And then other types of investing. So over my time, I've grown a few businesses. Mostly from scratch. I don't tend to buy stuff. I tend to build it from nothing, and build it up and then sell it on. That is what I have got a history of. And what I was finding was that when I was building these businesses, I was creating surplus cash flow, and I had nowhere to put it. And that's what really got me investing in property, because I had this pot of money that was sitting there and growing and growing and growing, and I had nowhere to deploy it. So I started investing in property, and like most people do, I started putting it into buy-to-let properties because straightforward, easy. Everybody knows about buy-to-let properties. So put it in buy-to-let properties. And then me being me, I was analyzing the data on those buy-to-let properties, and I was coming away every month with about 100 quid. I thought, this isn't right. I'm making 100 quid a month. This is not the way it's supposed to be. I should be driving around. I should be driving down to the south of France in my Aston Martin with my sunglasses on, ready to spend a week away, just doing nothing, just on a whim. That's what property investing is all about, isn't it? But there was me making 100 quid a month, thinking that I was doing something incredibly wrong. And of course I was doing something wrong. I was doing the most vanilla, the most low risk, the most unexciting, the most ill-informed kind of property investing there was. So that was the catalyst for me to really start finding out about how to really invest in property, how to increase your returns, and whether property was the right thing to invest in, as per the subject of this webinar. You know, is it property, or is there a better place that you can put your money? So I did a lot of research. I educated myself. I went on a few training courses, and I made sure that I was absolutely 100% up to speed with what I was doing with my money. And at that point, I started to think that actually what I should be doing is exiting all the businesses that I'm running and just managing my property investments, because I could probably make more money by doing that. And that is exactly what I did. So in my time, I've been involved in property investments from £55,000 up to £150 million. So I've got a really broad scope of investments that I've been involved in. I've executed lots of different property strategies. And actually, after I exited or after I stopped looking at buy-to-let as an option for me, I went straight into HMO. So HMO was the second strategy that I looked at and started to execute and make money from. But I've done lots of other things within my own portfolio, and now I oversee all franchise operations, which means that not only am I helping 150 odd people run their own property businesses, but I'm also looking at every deal that those guys are finding, and I'm able to help them in terms of coming up with the right strategy and the right structure for these guys to deploy for their property businesses. Sorry, I just got a question in the chat box. So, like I said before, if you can please put your questions in the Q&A section, that would be really helpful. The question was, though, will the slides be shared? And yes, they will. So what we do at Source Franchises, we are here to help our franchisees get deals done. Now, you might be aware that we've got Source Capital, which is a sister business, and that Source Capital offers funding to our franchisees to get their property deals done. But the purpose of franchise is to get deals done, not to feed Source Capital. We at Franchise are here simply for the execution of property deals to make sure that our franchisees are making money. That is our purpose. And that is a picture of me taken before lockdown. I'm sure I've aged about 10 years, and that picture was taken about a year and a half ago. Anyway, so Source success so far, since we started, which was just in around January 2017, which is when the concept of Sourced came about, and it was Stephen Moss that came up with the idea of Sourced. It took him a few months to really put the processes in place and put the right structure in place to then launch the franchise model, which was done in September 2017. I came on board with Sourced in about January 2018, so very, very soon after its inception. Sourced received FCA approval in August 2018. We hit 40 franchisees later that year. Our £150 million development was launched in February 2019, about a year after I'd been involved. We were approved for ISA and pension funding through Source Capital in March 2019. Source Care was launched in September 2019. And then the franchise operation and the capital side have grown very, very strongly since then. So Capital raised over £10 million in its first full year of trading, and the franchise business has grown to around, I think to be completely accurate with you, we're on about 143 franchisees at the moment. So what we do is we provide a simpler, faster, more trusted way to invest in property. Property doesn't always have the best reputation, and it's our mission to be transparent, to be honest, to make property investing available to everybody in a much simpler format. You know, if you want to buy a property and you want to make money out of that property itself, just the conveyancing process. Well, we've got a conveyancing process for one of our properties at the moment that's going through, and because of the legal ramifications, it's taken a lot longer than we expected. And so what we're trying to do at Source is we're trying to make investing in property simpler, faster, and available to everyone. And to do that, we've got 5 different brands. So if you've been to our website, you'll have seen that we've got 5 different colors which represent our 5 different brands. From Source Franchise to Source Care, Source Developments, which is a place that we show the developments that we at HQ are taking care of ourselves. We've got Source Capital, our peer-to-peer lending arm, and we've got Source Property, where if you're interested in finding property deals, you can go there and you can download not only property deals themselves that our franchisees have found, but there's a huge amount of free content there as well. So in terms of the successes that we've had, we've been going for 3 years, but in terms of successes, we've got quite a few to boast about. 2,500 deals per month, which are analysed. So the franchisees go out there, they find the deals, and then we at HQ help them analyse and do their due diligence to make sure that they're only going forward with deals that make financial sense. Like I said, we've raised over £10 million last year from Source Capital. We've got 143 franchisees, so over 100 franchisees. We've got well over £1 million worth of deals in the pipeline. Actually, we sat down yesterday and looked at the number of deals that we've got in the pipeline, and I think we're somewhere like £7.6 million worth of deals in the pipeline, which is really exciting. Lots of different strategies and structures have been put in place across the UK, but the purpose of this webinar is specifically to look at property portfolios and running a property portfolio versus other investment classes and how they fit. So which investments are we going to look at? Well, in terms of having a sort of a passive, a kind of investment strategy whereby you don't need to put a huge amount of time and effort into it, we're going to look at stock, shares, and funds. We're going to look at HMO properties. We're going to look at more modern investments. So that the example that we're going to use is going to be Bitcoin, and then we're going to look at commodities. So very, the four, if you take HMO properties as being property, the four most common investment types that people go for when they're looking for a good return on their money. So pros and cons of stocks, shares, and funds. Firstly, you've got a range of investments. You've got lots of different things and ways that you can invest, from trusts, unit trusts, and lots of other different methods and different things that you can look at in terms of your investment. And you can purchase them really, really quickly, can't you? I mean, there's apps on your phone where you can purchase something within, I mean, if you've set up your account within 30 seconds, you can purchase something. You've got lots of information as well. I actually have an account with eToro, and the amount of information that you can get when you're looking at an investment, and the amount of information you can get to see what other people are investing in, is absolutely phenomenal. The information exchange for this kind of stuff is huge. You can also purchase something that you're passionate about. And I hear a lot of people doing that. The people that have an Apple Watch, an Apple phone, an Apple Mac will probably buy Apple shares because it's something that they are, quote unquote, invested in already, right? It's something that absolutely fulfills their values and beliefs. It's something that they're passionate about. And so that's what they're going to invest in. And that will make them feel good because they're funding something, they're helping to fund something that is that they like using themselves. You can also make growth, and you can make income from investing into stocks, shares, and funds. So you can make capital growth based on the value of the stock or share, and you can also make ongoing income in the form of a dividend. So not only are you investing in this thing that is appreciating in capital growth, but you're getting cash flow from it as well. And obviously that's dependent on the performance of whatever you've invested in. And that's not necessarily going to be the case all the way through the lifetime of that investment, but you can make cash flow from that kind of investment. Now, the cons are there's not always any securities or guarantees. So if the value of that share goes up, then you're going to benefit from the value of that share. If the value of that share goes down, however, then there's no security in terms of how much money you could lose. Now, when you invest in something like eToro or Plus 500 or something like that, then you can always set a limit to exit you from that investment. And again, the exit from that investment can be just as quick as the purchase of that investment. However, that money down to that point, you will lose. There is no security that means that you can fall back on something to say that, I need to sell this. However, I want to make sure that I retain or claim back as much money as I possibly can. And of course, with stock, shares, and funds, there's a lot of market volatility. You just need to look at what's happened since coronavirus to see the value of something that is traditionally quite stable, like the FTSE 100. And then if you go into an individual stock, the FTSE 100 is traditionally quite a good thing to invest in if you're looking for certainty, because you're investing across a portfolio of stocks. So you've got 100 stocks that you're investing in with the FTSE 100. However, if you pick a stock in particular, so for example, Apple, and something happens, and Apple, there's a big scandal with Apple, or something happens specifically with Apple, and the value of that stock goes down, then again, you've got no guarantee, you've got no certainty that you're going to be able to get your money back. Now, looking at HMOs, firstly, we work with a company called Centrepoint. They're a charity, and they provide housing options for young homeless people. And one of the statistics that really jumped out at me when we watched the presentation by Centrepoint was that they were predicting that 75% of under 25s by the year 2025 would be living in HMOs, or shared accommodation. Now, the current number is absolutely nowhere near 75%, but obviously what they're saying is there is such a shortage of housing that really HMOs and the benefits of sharing the cost of living in a house, which HMOs give young people, are going to be so powerful that the HMO market is going to grow exponentially. Now that's really interesting. That was the one part of that presentation that really sung out to me, because what that is telling us is that HMOs are going to get more and more popular because they are a more affordable way for young people to become independent. Now, HMOs, very similar to stocks and shares, you can earn a cash flow from the HMO, and you can earn capital appreciation. So while you have your investment in that property, and that property is going up in value, you're also making a cash flow. And the cash flow from a HMO can be very reliable. If you do your research, if you make sure that you're making good decisions when you're deciding to purchase the property, then you can rely on that cash flow as you rent the property out. Now, this is the most interesting thing about HMOs, because their property, your investment will be secured against an asset. So your asset, the asset that you own, that property that you own, is subject to market fluctuations. However, if you look at the market fluctuations of, say, something like a stock or a share, and you look at the market fluctuations of the property market is much, much more stable than other markets. And so you've got that relative stability that gives you confidence that you're going to be able to sell that property and make your money back while you're making cash flow as you own that property. So the property market is incredibly stable. Now, one of the things that happen when people report on the income that you can make from a stock or a share, and the income that you can make from commodities, and the income that you can make from from investing in property, is that they compare only the very most vanilla type of property investment, and actually a lot of them don't take into consideration the cash flow that you can make. So when you look at the value of the FTSE, and say that it's gone up by 7% over the last, on average, every year over the last 10 years, then compare that to and I've seen this over the last 7 days as I've been looking at this presentation. You compare that to the value of property and how the value of property has gone up or down. Then all people tend to take into consideration is the overall increase or decrease in the property market. Now, stocks or shares on average have gone up over the last 10 years by about 7%. Property has gone up on average over the last 10 years by about 11%. But that doesn't give you the full range of options when it comes to property, because what you have with property is you've got the ability to purchase below market value, and you have the ability to create a huge amount of cash flow from that property as well. So when you put all of those things into the basket in order to compare property with its capital appreciation, with its cash flow that you're generating, and the potential to create your own capital uplift in the property, how does that look in comparison to other investment types? Well, we'll get to that in a little while. So what you can do is you can add value to the asset to force that capital appreciation, which means that you could buy something for, let's just use some rudimentary figures, and we will get more specific and look at actual figures later on in this presentation. But let's look at rudimentary figures. Let's say you buy something for £100,000. You spend £30,000 on it, but then it's worth £200,000. Well, now you have a saleable asset worth £200,000, which gives you not only instant capital uplift, but a huge amount of security over your initial investment. So this is a growth and income investment opportunity. And there are, of course, some negatives in all kinds of investing. And as I said earlier, the conveyancing process is slow in comparison to purchasing a stock or a share. Purchasing a property can take much, much longer. So modern forms of investment, let's have a look at Bitcoin. I'm sure you've heard of Bitcoin. I could have chosen lots of different cryptocurrencies, but Bitcoin is the most popular. So that's where we'll start. So process to purchase is fairly quick. It's, again, very easy to access information. There's a huge amount of information on the internet about all the different types of coins that you can purchase. This is the one thing that I think everybody knows about Bitcoin. Potentially, there is a huge potential for growth, as you can see, especially in the last year with Bitcoin. You can exit the investment quickly, and this is mainly a growth investment. So it doesn't really produce an ongoing cash flow for you, but it is purely about putting your money into the growth of that investment. Again, the cons: no security or guarantees. So I'm sure you've heard just as many stories of people buying Bitcoin when it was quite low and making a lot of money because it went high, and then heard just as many stories of people that have bought high, and then all that happened after they'd bought is that the value of the coin went down and they've potentially lost quite a lot of money. And therefore, Bitcoin is known, and modern investing like Bitcoin is known for the incredibly volatile markets in which they sit. So cons: just like there's potentially huge growth, there are potentially huge losses. And like I said, there's no ongoing income. We'll see how that has performed and how that sits with everything else all together. And then looking at gold, something like gold. So we're looking at commodities. I'm picking probably the best known one, which is gold, which is very well established. And it's in times of volatility, gold is the place that a lot of people put their money. And that's when you see the value of gold really go through the roof. Well established, easy to access the information again, potentially good growth value. You can exit the investment quickly. It is predominantly a growth investment, but there's not really that much change in the market. It's a fairly well established market, so you see that the growth is quite slow, and it's a good, solid, reliable market. However, your potential for making huge returns is probably quite limited, and then you've got no ongoing income, and again, no real security. So where do people actually choose to invest? Well, 33% of British people invest in stocks. So stocks are still one of the most favored investment choices for people in the UK. But and there was a survey done, and I can't remember the website that I took this information from, but when I was looking at the website, they also asked people why they invest in stocks, why they made that choice. And really their reasons were all sort of negative reasons. So poor rates from the bank, and they want to earn an ongoing income. So they're liking the dividend aspect of investing into stocks. So they're not looking at stocks and saying they are the best. They're not looking at stocks from a positive point of view. They're motivated by the negative emotion of where their money currently is and what their options are. So they're thinking that their options are either the money stays in the bank or the money goes into stocks. And of those two options, they'd rather take the risk and put those stocks into put their money into stocks. So you've got to imagine, or you've got to think that a lot of people are motivated by that, or a lot of people are pushed towards stocks, away from their bank accounts, away from the savings accounts, because they think that that is the only option. And really, what does that come down to? That comes down to a lot of marketing. A lot of marketing where people are shown funds, they're shown stocks, they're shown that kind of thing that they can invest in, and therefore that's why they make that choice. Now, why are those options marketed heavily? Well, they're marketed heavily because there are a huge amount of fees and ongoing commissions that are earned by the people who get you to invest into stocks and shares. Not only the fees to purchase, but sort of trailing commission if you're going to use a broker. There's lots of different ways that third party that is helping you invest can make money. Whereas it's a little bit more difficult when it comes to other investments, such as property. So property, like I said to you earlier, property is usually reported as only the increase in market value of that property. And it doesn't take into consideration a forced capital uplift. It would be very difficult for it to take that into consideration because that's all about your individual choice that you're making. But it doesn't take into consideration that capital uplift that you can create. And it also doesn't usually take into consideration that rental income, which something like a HMO can specialize in. So why would we look at HMOs specifically? So with HMOs, you have a very high and a very stable cash flow. And that's all based on doing your research at the front end of purchasing that property. So on all of our training courses that we run for our franchisees, the training courses on properties are split into 6 steps. And the first step in every single training course is research. Because if you're going to make the right decision you need to know the parameters by which you're making that right decision. And therefore, you need to do your research in order to in order to have certainty that you're going to make that cash flow that you're predicting when the property is up and running. So HMOs create a high and stable cash flow. And like I said to you before, you can create that capital uplift, which instantly means that you have a lot of equity in that investment. Managing agents can free up your time. So even though it is an investment in property, then it doesn't have to take up more of your time than, say, investing in a stock or a share or a fund that you then put your money into and then forget about. So it is, in terms of having free time to invest in property, it is absolutely comparable. And a HMO can be trading in a short period of time. So when people think about investing in property, they think about, building a new house or building a new housing estate, depending on how much money you want to invest in the property. Now, doing that means that you would have to invest a lot of money at the front end, and you're probably not going to see the return on that money for 2, perhaps 3 years, depending on what that investment is. Whereas with a HMO, you can purchase the property and then you can have that property up and running within a month, depending on the amount of refurb that you need to do to that property. But certainly within a month, that property could be up, running, cash flowing, and gone through that process of capital appreciation already. So in terms of when you start to make money from HMOs, it's much, much quicker than bigger projects that people are doing in property. So as always, there's a couple of questions that are very, very important. And like Richard Branson says, you always need to look after your downside. So top 2 questions when you're calculating whether the investment is the right investment for you. So the first one, will I get my money back? And the second one, will I get the return that I'm expecting? So when you're looking at choosing an investment, you can, when it comes to property, you need to look at the market volatility. And when it comes to stocks and shares, you need to look at the market volatility. So when you're investing in property, the volatility of the property market is very low. And if you're creating that capital uplift and you're creating more equity in the property, it means that you've got more certainty that even if the property value does come down, you're still going to be able to sell that property and get back what you had put into it at the front end. Whereas when stocks and shares go down, gold goes down, Bitcoin goes down, or modern investments go down, then you don't have that same certainty. Now, to give you an example of how stable the property market is, the last crash that we had was in 2007, 2008, when during the credit crunch. Now, that was the biggest dip in property. And if you remember, around 2008, there was a huge amount of media attention on the value of properties plummeting. Well, actually, looking back at the data now, the property market only dipped by 15%. And so if it dipped by 15%, if you've made good decisions in the properties that you had bought and you had created capital uplift and you had that ongoing income from the cash flowing income, then potentially that wouldn't have really hit you in any way. Now, that all depends on the way that your property is leveraged and the way that you operate your portfolio. But certainly a dip of 15% with the portfolios that I have owned over my time really wouldn't have made that much difference. So let's look at the reported returns. So we're going to look since 2018, and that's not me trying to manufacture the numbers based on choosing the right number of years to make property look good. That's purely based on Bitcoin, and when you could start generating reliable information from Bitcoin. So since 2018, the FTSE 100 has gone down by about 14.3%. Gold has gone up by 31%. Bitcoin, unsurprisingly, and mainly from this year actually, has gone up by 353%. And property, like I said to you earlier, has gone up by 11%. But that, as suggested to you earlier, that is purely the market uplift in property. So you look at those four metrics, and you probably think that property is fairly sedentary. It's not really that exciting to get into property. And if you want to make big returns, you're far better off going for something like Bitcoin. Now, gold's gone up because people have turned to gold for that certainty. Now, over the next few years, as we exit, coronavirus, and as we start to go into a period of more market certainty, gold will probably not go up by that much more. However, Bitcoin, who knows where that's going to go? Could continue to go up, could continue to go down. But property, in comparison to all the other investments there, well, apart from the FTSE, but property certainly looks fairly sedentary and not really that appetizing at all. But that's because all they're doing is talking about the market and not talking about the kinds of returns that you can generate. So we have, I'm going to show you a property deal in just a second from our deal calculator, in which we have bought a property. It's actually a HMO that I sold, so I'm very, very familiar with the numbers from this HMO. So I sold this HMO to an investor. So I had found this HMO and I sold it to an investor to then add to their portfolio. What they had done with my help was they had bought it on short-term finance, they'd refurbed the property, and then they'd refinanced it onto a long-term HMO mortgage. And in doing so, they had released all of the equity that they'd put into the property. So technically, they had no money left in that property whatsoever after they had refinanced it. But not only did they still own the asset, but also they were creating £1,491.22 worth of income every month, which gave them an ongoing income every year of just under £18,000, but they were creating a 13% yield as well. Now, just think of that for a second in comparison to the other investment classes that you can look at, because what that does is it gives you the opportunity to potentially invest, let's say, and let's use round numbers, £100,000 into a property project to start off with. But then you could refinance that project and you can pull out all, or in most cases, the majority of the money that you put into that project, and potentially leave in £20,000 to £25,000. And then you'd be making a return based on the £20,000 to £25,000 that you'd put into that project. And with the other money that you'd refinanced and taken out, you can then move on to your next project. Just to give you the transparency, this is the deal calculator that we used, that we designed, which shows that property project. So I know it's a bit small, but I wanted to get all of it on the screen to make sure that you could see that, see all the numbers and see that we were taking absolutely everything into consideration. So the purchase price of that property was £55,000. It was £30,000 to do that property up, and it revalued at £135,000. And then this box here, which I'm just circling, this shows the money left in the deal after refinancing. And as you can see, that box is empty. So the actual return on capital employed, how hard your money is working, the metric to compare any kind of property deal with stocks and shares, with Bitcoin, with gold, because it tells you how well your money is doing. Well, that return on capital employed in this case is infinite, because there is no capital employed. There's no money left in this deal. It's just pure profit as soon as it's been refinanced. So that's, I can tell you the address of that property. I know exactly where it is. I remember walking around that property being amazed that it was in such a disgusting state, but that is what creates the best opportunity. Now, I'd say that out of every 20, 25 property deals that we see here, HMO deals that we see here, one of them will be similar to the one that I've just shown you. This kind of deal is much more reliable, much more predictable, and much more common. So this is a purchase of £215,000 with a revaluation amount of £453,000 after about £95,000 had been spent on it. Now, as you can see, the box that we highlighted earlier, this one here, it does have some money. It does have a number in it, which means that upon refinance, this property is going to require £34,000 to be left in the deal. However, if you look down here, it's also creating a cash flow of £40,000 per year. which generates a return on capital employed of 117%. Now, you take that into consideration, and these are the kind of deals that we see fairly frequently. Take that into consideration as a comparison against what kind of property returns are reported. Because what we reported to you was 11%. And I could find that 11% everywhere on the internet, because the property market on average has gone up by 11% since 2018. But when you stop looking at generics and you start looking at specifics, you can really see where the opportunity is in property. And it's far easier to look at property and to look at a property and do your research and find out what kind of returns people can generate from that property based on what's already there. Whereas if you look at a stock or a share, or you look at Bitcoin, you might look at, I don't know, American Airlines. And if you're looking for comparables, you might look at Boeing. But it doesn't work like that with stocks and shares. You can't compare one to another just because they're fairly similar businesses. But you can do that with property. You can do your research with property, and you can predict what kind of returns you're going to make. So it's a much more predictable asset in terms of giving you the security and the certainty that you need in order to invest your money. I'm just going to have a look at the questions, because I've got one. Do you manage the refurbs yourselves too for the investor? So we are sourced HQ. Our franchisees find deals and do deals, and the franchisees would manage the refurbs for the investor if they're selling the deals on, yes. So we at HQ would support our franchisees in doing that, but it is them who would do the refurbishments and help you out with project managing that process for you. So this is, like I said, a fairly common deal that franchisees will find, but when it comes to property, it's a far more interesting asset class than is generally reported for reasons like this. When you look into individual deals and where you're going to park your money to generate a return for you, this is far more interesting to me than it is to look at just the generic sort of market movement. Because you've got to take into consideration that this 117% return on capital employed, you would then get the market movement on top of that. So as well as generating 117% return on capital employed based on the day that you refinance, you've then got that income coming in, and you've got the 11% uplift in market as predicted since 2018, or as reported since 2018. So you've got a double whammy of the actual specifics and the generics working in your favor. Just got a couple of other questions here. Let me just get there. The amount of rooms in the HMO that I'm showing that's a good question, is 12 for that one. Changes in minimum C EPC ratings affects HMOs. Well, it's just, so let me read that question out, because I realized that I just mumbled it. So how will new changes in minimum C rating EPCs affect HMOs? Well, the HMOs have to be up to that standard, don't they? It's the same as renting out any property. But if you've got to look at this as, if you're managing that process, then in this property specifically, we're spending £95,000 on the refurbishment of this property. If we have to get that property up to a C rating as well, it might cost another 1,000, 1,500 quid or so. In terms of the overall investment and how that entire thing comes together, it's not going to be a deal breaker. It's not going to have that much of an impact on it really at all. So these are our deal calculators. I wanted to show you because I wanted you to see that I was being fully transparent with where the numbers are coming from. So the 34,418 left in the deal, £40,000 return per year. So you've left £34,000 in the deal. For that first year, let's say, you're paying yourself back. And that's the net return as well, going by the deal calculator, because we've taken off the costs. So you're paying yourself back for the first year. And after that first year, everything that you're creating is profit. Just got another question, which I'm going to answer now because I prefer to do it at the right time. Can I simply purchase a HMO from source without having to become a franchisee? Yeah, you can sign up to our deals. Our franchisees find deals find HMOs, and they put them out on our investor list. So if you want to be on our investor list, then head over to the property section of our website and sign up to our list, and you'll get alerts when new properties are listed. Now, our HMO partner program actually gets to see those deals before we send them out to the general public. So if you wanted the absolute best deals that our franchisees are finding, then you would need to come on board as a HMO partner. What are the pros and cons of buying HMO by a company rather than a personal? So really, that's a tax and ongoing costs and what's the word I'm looking for? Yeah, that's a better question for your accountant. There are of course pros and cons in buying a HMO in a company rather than buying it as an individual, and mainly it's about how much tax you're paying. That overall situation doesn't just look at the property and how much tax that property is going to generate for you. It looks at how much tax you're currently paying, what your other income sources are, how much tax you pay overall. So that's a far better question for your accountant who has access to all of your financial dealings, because it might be worth you putting it into an SPV in order to shield that income from you. There are also other benefits when it comes to paying stamp duty, but the main thing that you need to look at is your overall tax position, which is a far better question for your accountant. So that's where we are with the amount of income generated by that one property. And then, like I said, the value of that will then increase by 11%. So let's look at that in comparison to the other three that we were talking about earlier. Now, all of a sudden, generating 117% return on capital employed and then 11% market uplift on average year on year now gives that HMO market a completely different twist. Because now you're looking at that 117% with the 11% growth and saying, well, actually, that market not only produces a phenomenal return for me, but also it gives me security of knowing that that return is coming from a much more stable market than something like Bitcoin, or a market that's much more likely to continue to grow on an ongoing basis in comparison to something like gold. And so property becomes a very, very serious contender with the best returns that you can get and the most security that you can get. So when it comes to property, a lot of people look at property as being the solution, as being the right thing to invest in. But what are the issues? And why don't more people just take their money, do the brave thing, start to buy houses? Well, as we at Sourced have found out, because we've been there, we've done it, we've made those mistakes, you need to make sure that you're making the right decisions. Because certainly, and as I told you at the beginning of this presentation, I didn't make the right decisions when I first started. I bought property because I thought it was the right thing to do. However, I've learned that you need to be very specific and very focused on what you want to achieve out of property. So to start off with, you need to select the right strategy. Once you've selected the right strategy, you need to make sure that you've done enough research to select the right property that is going to deliver the returns that you're looking for. You need to do the refurb to the right level. And not only in terms of compliance and getting it to the right standard when it comes to HMOs, but also is that level of refurb and what you're planning on doing correct for the situation and the location of the property. You, of course, need to make sure that you adhere to the right standards. And when it comes to property, there are lots of different local standards that you need to adhere to. And that's one of the things that we can help you with very, very well, because we have so many franchisees in so many different parts of the country. But adhering to the right standards means that you're going to be able to make your return, make your income without the interference of, say, the local council. You need to make sure that you're maintaining the right compliance for the property, and this kind of thing can change all the time. As the person, sorry, I forget your name, mentioned with the C rating for the EPC, that kind of compliance happens all the time. We are obviously taking a huge amount of our time to look at the compliance changes, look at the legislation changes, and feed that back to our franchisees in order to make sure that they're doing what they need to for their properties. And then that's creating all of those things combined, create the right returns like the ones that I've just previously shown you. So current risks in HMO. Now, the main thing that people, and I do a lot of training courses for HMO, so really this is absolutely true. Current risks, the misunderstanding of the legislation and planning compared to buy to let, for example, Article 4. So with HMOs, there is an increased amount of legislation and there is an increased amount of planning. For example, did you know that HMOs that have got more than, well, depending on the area of the country, if you've got more than 3 people from different backgrounds with shared facilities, then that would count as a HMO. And therefore, you'd be on a different use class to a normal property. So a normal property is use class C3. Most HMOs are going to be use class C4. But most people don't understand that. Now, going from C3 to C4 is allowed under something called permitted development. However, an Article 4 area in a location would stop you making that change from C3 to C4 under permitted development. It would require you to go through full planning to make that change of a property. Now, most people misunderstand exactly what Article 4 is and have no idea about the use classes. So yes, there is more research that you need to do in order to be compliant with changing a property into a HMO. Again, we put on training courses for anybody that comes on board with us. And these training courses are ongoing, no additional cost. We actually get planning consultants in to deliver these training courses in order to help the HMO partners understand what the requirements are. There are fewer mortgage providers in comparison to buy-to-let, but again, we have specialist brokers within our network who are linked into these mortgage providers and can arrange those mortgages and help you arrange those mortgages. Larger deposits may be required from those mortgage providers for first-time landlords, but again, that would depend on how good the property is that you found in the first place. Because ideally, we'd want to be in a situation where you're actually refinancing and pulling your money out. There can be higher startup costs from furniture and regulatory items such as fire doors. Like you might need to put FD30s in the properties with intumescent strips, and what level of fire alarm you need to put in there. So again, understanding that what is required of you is more of a risk, and making sure that you're compliant. Fewer letting agents will be willing to take on HMOs. The capital growth can be lower if you've refinanced to the full market value of that HMO. You might experience lower capital growth. Not every property can work as a HMO, so your due diligence and the number of properties that you need to look through in order to find a HMO in the first place can take you a lot longer. And then looking at the opportunities going forward, the rental yields can be a lot higher. You've got less of a risk of void periods, and really, first of all, the void periods that you should experience should be less impactful on you, because if you have one room empty, you should still be making a profit on that HMO. But my argument is always that if you've done your research correctly, you shouldn't have any void periods at all. Because when a tenant gives you notice, you've got 4 weeks to fill that room again. And in the research, when I train people about research, I'm looking for areas of the country where you're filling a room again in 2 weeks, never mind 4 weeks. And so even if it's a bit slower in that area of the country, and the time doubles, you're still filling that room before the old tenant has moved out, or you're still signing somebody up to that room before the old tenant has moved out. And therefore, you shouldn't really be experiencing void periods at all. Yeah, you'll have less arrears, and there are lots of companies out there that can help with managing tenants who are not paying their rent. Again, we have tie-ins with them. Most spending on a HMO in revenue costing and so income is tax deductible. Yeah, absolutely correct. Again, something for your accountant to get excited about. Trend has swayed towards affordable housing, and like I said, we work with Centrepoint, who have said that they expect 75% of under 25s who are living away from home to be in HMOs. Looking at our success stories through 2020, one of our franchisees, Niraj, he grew his HMO portfolio to 195 rooms, and only 3 rooms have had a void period. Again, that's all about research. So he reinvested, created larger rooms for professionals. So that's looking at the market, being adaptable, being flexible, and buying in the right area. Because he's not saying that he's got rid of all of his portfolio from over here and bought over there. He's looked, when he originally bought those houses, he's looked at the demand, and he's looked at, there is a demand from students, but also there is a demand from professionals, and so he has that certainty that he's able to switch from one to the other in order to make money. And then going forward, he's going to be looking at a huge amount of deals and reducing his lending, and basically just making his portfolio much, much more powerful. I've got Mark Barrett, who is up here near Manchester. So he has had a couple of deals in which we have funded for him, and he has converted them to HMO. I think the latest one of which was in Salford. He's looking at social housing and long-term leases, so that he doesn't have to manage that portfolio, manage the lettings, or manage the letting company. Now, we have an arm called Sourced Care, and that is exactly what Sourced Care is going to be doing over the next 12 months or so, going out there, building relationships with housing associations, building relationships with commissioners in the local council who make decisions as to where their long-term leases will go. And then once we've made those relationships, we'll hand those requirements down to our franchisees to then put them in place for the HMOs that they own. So Mark predicts a huge increase in professional HMOs, and that's exactly what he's looking for now. He's looking to increase his portfolio of HMOs, and that's exactly what he's going to be doing over the next 12 months or so. So we've got 3 questions at the moment. I'm just going to go back to answer some of them. What is the percentage leverage banks give a company, and how much percentage would give an individual? So the latest refinance of a HMO that we had, as in we had in the network, not from us at HQ, was based on 75% of the value of that HMO, and that was to a company. From memory, the latest that we had was a while ago for an individual, because most people are purchasing, most people in our network are purchasing in a limited company, and it was the same for an individual. But I would say that was about 12 months ago that I saw the latest for an individual. But again, 75% of the value. Next question is, how easy is it to make HMOs work in high purchase cost areas, e.g. Guildford, as an example, as an expensive location? Yeah, I mean, look, we still look to build HMOs, and we still have franchisees that are building HMOs in London. And the reason is, where was I looking? I think it was in Kensington. And obviously the cost of a property in Kensington is very, very high. But then, therefore, so is the cost of a HMO room in Kensington. I think it was something like £1,200, £1,300 just for a room in a HMO in Kensington. And so if the price of the room is going up at the same rate as the value of the property, then the margin stays roughly the same. It's all about doing your sums and doing your research, though. What is the minimum amount required from investors to join your books? So the minimum amount from an investor, so just to clarify, do you mean you want to buy a HMO and therefore you want to be an investor from outside of Sourced, or do you want to become part of Sourced? So if you can just clarify that would be great. So moving into 2021 and our predictions for 2021. So you might have seen, or you might have heard about the property cycle in the past. And if, I'll make these slides available so you can come back and you can have a look in more detail at this property cycle in the future. But in my opinion, we're somewhere around here at the moment, where we're just going through, just coming up to the boom stage of the cycle. And as soon as restrictions are lifted, and as soon as more properties come onto the market, and as soon as lending is eased, which I think it will do once we come out of coronavirus, then that's going to go, I think we're going to go through the biggest and the fastest growth period that we see in the entire cycle. And that should last for a number of years. So we're seeing a 1% house price increase by the end of the year, 20% in the number of deals we secure for our investors as the market changes. We'll see over 25 million from Source Capital in investing in our franchisees' deals, and we'll be over 200 when it comes to the network franchisees with over 50 HMO partners. So the difference between the HMO partners and the network franchisees is that the network franchisees are in property full time, and the HMO partners are looking to build their HMO portfolio on the side of their main job. There's going to be a sharp increase in the number of professionals living in HMOs, and then we're going to see banks to provide higher deposits for first-time buyers. And you might have seen recently that there's been 95% mortgages that have been made available. So this is what we mean by lending being relaxed. More money available to the market to buy properties means that there are more people trying to buy properties, and therefore on the old supply and demand seesaw, it means that the property prices are going to go up, and we'll go through that boom phase of that property cycle, which I showed you earlier. So if you want to become an investor and buy a HMO from some of our network guys, then you need to go to the property side of our website and you need to sign up. That's all you need to do. We don't have any further requirements because you know how much money you've got, you know what kind of investments you can afford, and when you see an investment that you like, you can get in touch with our franchisee and take it forward from there. So how does Source help you? Why have we got HMO partner? Well, what we do is we enable you to create that portfolio to the side of your main job, your main project, where you spend most of your time. And we try and give you as much help and support throughout that process as we possibly can. So we give you HMO specific training, but then, there are lots of training companies and there are lots of training courses that you can go on. But what we do is not only do we give you that HMO specific training, but then we give you the support and the backup after that training to help you make the right decision all the way down the line. So if you find a deal, we'll help you assess that deal. We'll assess that deal after you found it to make sure that you're making the right choices and that there are no pitfalls in that investment opportunity that maybe you haven't seen or you don't understand. HMO is obviously a very proven strategy, and it has been very successful all around the country. Not only do we help you with deals that you found yourself, but also we've got a network of lots of franchisees who are finding deals. So you will get first refusal on those deals that the franchisees find. So you'll get to see those deals before they're released to the public, and you can choose whether you want to move forward on those deals that the franchisees find, that the network franchisees find before anybody else can. And then from Source Capital, we can offer you up to 100% funding of the purchase price and 100% funding of the development based on the exact metrics of the deal. And what that does is, even though you might have some money in your pocket, you might have something that you're looking to invest, having the capacity to come to us and get funding from us means that you can scale your portfolio much quicker. So what you might be able to do on your own in 5 years, we could help you achieve in 2, for example, because we can help you scale it up. Just getting another questions. How many Source partners do you currently have? Yeah, that's a great question. So the Source partner side of our franchise, we launched just a few months ago, and we currently have 7 partners. I'd say 40% of those partners since they've come on board. So we had some people come on board 4 or 5 months ago. Some more people come on board just 2 months ago, and 40% of them are currently buying a HMO right now with our help. What returns can you expect from HMO? So as we've talked about, and as I've shown you specific examples of, per property, you could be making up to about £40,000. And in terms of income, depending on how quickly you scale, you could be, just multiply that per property by the number of properties you want to make. We've put 50 to 150,000 pounds because that's very, very achievable. But if you want to buy 10 HMOs and each one of those HMOs is making you £40,000, then clearly that's £400,000 and a lot bigger than the numbers we're giving you there. Return on your portfolio is going to be between 10 and 15%, and that's in terms of the market value of that portfolio, not taking into consideration that cash flow. But then return on your equity can be 30% plus And that's the really important thing, because plus means that it just depends on the quality of that individual project that we can help you find. So how does it work? The network franchisee sources the HMO opportunity for you. They crunch the numbers and then they put it to HQ to review. One of the support team at HQ will review that property, and then before it's sent out to marketing, we will send it across to the source partners. So there you go, it's gone across to marketing, then it comes out to the partners, and then the partner can either accept it or reject it. If it's accepted, then they can take that property on, and they can go ahead and purchase it. And if it's rejected, then it goes out to marketing to the general public. If it's accepted and you want to go through Source Capital to help you fund it, then we've got all the information in the CRM system already. We just set up a call with you, with the original network franchisee who found the property, and with the support person, and probably me as well. And then we just talk through that opportunity and make sure that that is fundable by Source Capital. Let's have a look. Another couple of questions. Do you only specialize in HMO, or can you venture into commercial properties? So long as the exit is a HMO, then you can look at commercial properties. With the HMO partner, it is specifically looking at building a HMO portfolio. If you want to get into different kinds of property investing and different kinds of strategies, then the network would be more your kind of thing. I live in Africa with no UK income apart from buy-to-let real estate investments that I own in London. If I have 50% equity for each deal, can you help me raise funds for the balance? Potentially, if you give me, drop me a message afterwards, I'll give you the email address and we can take it from there. What is the current joining fee and ongoing costs for HMO partner? It's not going to surprise you to know that I'm just going to get there. So just bear with me a second and we'll get to that point. So as it says, training is only demonstrating that it is possible. But what we do is we put on as many training events as we possibly can to make sure that you guys are educated before you start making decisions. So you're educated. So that means that you're making better decisions without us there, but we are always there to help you make decisions if you don't feel confident or comfortable to make those decisions on your own. So in terms of the types of training courses that we put on, we specifically look at sourcing. We specifically look at structuring and funding your deal. We look at lettings and occupancy. We have a specific course for planning, and then we have a refurbishment and conversions course as well. So all the way through that lifespan of owning and managing a HMO. The only course that is compulsory is the induction course. The induction and introduction to HMO is compulsory. Everything else you can come on yourself, because the sourcing course, for example, you might be using our network franchisees to source the property for you. You might also be using them to refurbish the property for you, and you might be using a letting agent to let the property out. So you might not need to come onto those other courses. They are there totally to help you out if that is what you need. And the training courses repeat every 4 months. In terms of the ongoing support, so that's me and one of our franchisees, Ben, and we sat down, Ben and I sat down after he joined, after he came on the induction, and we structured a plan for him to build his portfolio. And when we created that plan, it is then a joint responsibility that we will, if he's not delivering on that plan, I'll make sure that I hold him accountable to that. So it's not just running information by us, it's also making sure that we are pushing you to achieve what you want to achieve. Again, one of our other franchisees, Stephen, our managing director, and me having a meeting with one of our franchisees, looking at a specific property deal in that case. So running costs. Not only do you have the backing of a trusted brand and experts in the line of property, but you've got the full training schedule, you've got the funding capacity from Source Capital, and you've got comprehensive support, backup, and a network finding you HMO leads behind you when you come on board with Sourced. That costs £12,500 plus VAT. There is also, because it's part of a franchise, an ongoing fee of £200 per month. And for that, we offer you tenant support. We continue to give you off-market HMO opportunities, phone, video support, support days, training sessions, Zoom calls, all that kind of stuff is going on all the time. We've got our bespoke CRM system to help you manage that property, comprehensive training, access to the peer-to-peer platform. We've got lots of development resources, access to contracts, and all the legal side that you would need. You get a dedicated mentor, and that's £200 per month, and then 5% of the gross rental income. And the reason that we've made it the gross rental income is because we want to keep our ongoing running costs as low as possible, and the 5% comes when you're making money. So we'll take our profit level when you're already making money, in order to make it fair and a good ongoing arrangement. So what we would require is, we would require you to have some money in the bank in order to move forward with Source HMO partner. And that is, if you're looking to buy in the north of England, you'd need to have £100,000 minimum. If you're looking to buy in the Midlands, £200,000. And if you're looking to buy in London or the South, you'd need to have £300,000. Because we only want to work with people who are very, very serious about building their portfolio. And like I said to you at the beginning, or when we were looking at the deal calculators, in some cases, you might need to leave some money into the deals as you're building your profit, as you're building your portfolio. And so we want to work with people who are absolutely dedicated and have the funds to purchase those properties in the first place and leave some money in while they're making a great return on the money that they leave into those properties. And like I said, we work on the basis that we make money when you make money. So if you've got any questions, please feel free to get in touch. philip.hughes@source.co is the name of our HMO partner manager. And you can use that email address, send him an email. And if you've got any questions about this, then Philip will be very happy to help you. I've got another question, which I'm going to look at now, which is, do you have estate agents that can help with the running of the HMO properties? So there's two sort of levels to that answer. First of all, we do have quite a few estate agents and letting agents in the Source network. And secondly, we have a lot of franchisees who have their own portfolios that use HMO letting agents. And so if we don't have somebody directly in your area, we will have a franchisee there who will be able to recommend a letting agent that they've worked with before. So, you know, in terms of leaning on us for shortcutting the advice, for shortcutting the decisions that you're making, and making sure that you're avoiding the pitfalls, then, you know, we've got people all over the country that can help you out with it. That is exactly why the partner franchise was launched, because we saw a huge demand for people that just wanted to build a portfolio of properties, because they knew, they could see that the HMOs were creating a huge and very, very exciting return in comparison to other investment opportunities. So there's no other questions for me to answer. That is the end of the presentation. Please use philip.hughes@source.co if you've got any other questions ongoing. And otherwise, thanks very much for spending the afternoon with me, and I will speak to you soon. Thanks a lot.